Now, creditors turnover ratio. As the name of the ratio is telling you, this ratio establishes relationship between creditors and turnover. In this ratio, the expression of turnover is credit purchases, because creditors are always related to credit purchases. If in the company no credit purchases, it means no creditors. So creditors are the creation of credit purchases. So the formula will be turnover upon creditors times. It is always expressed in times. Normally all turnover ratios are expressed in time. Here turnover means credit purchases. Credit purchase means net credit purchases. I mean to say gross credit purchases minus purchases returns. And creditors means creditors as well as bills payable. So creditors includes bills payable in this expression. Actually, the objective of this creditors turnover ratio is how efficiently creditors are being managed. Means how is your creditors management? Creditors management means how you make the payments to the creditors. Naturally, if you are making payments to your creditors in due time, you will be enjoying good reputation and goodwill in the future. If your creditor management is not efficient, it means you are not able to pay your creditors in time, and it may spoil your reputation in the industry. This ratio is higher, then it is better. If creditors turnover ratio is low, it means it's not a healthy sign for the company. For example, during the year, company made net credit purchases of rupees 1,20,000, and on average basis, the creditors were 10,000. Means you know the formula is turnover upon average creditors, and average creditor means just like debtors turnover ratio. Opening creditors plus closing creditors upon 2. Creditors includes bills payable. Be careful. So let's come back to the question. Suppose credit purchases are 1,20,000 and average creditors are 10,000. It means creditors turnover ratio is 12 times. If we want to calculate average payment period to the creditors, it's quite easy. If you want to calculate in months, suppose, then it will be 12 months upon creditors turnover ratio. That is 12 times in this question. It means 1 month. If the creditors turnover ratio is 12 times, it means average payment period is 1 month. It means if you buy the goods today and you make the payment to your creditors after 1 month. This is the expression of average payment period. Suppose next year the credit purchases were the same. I mean to say 1,20,000, and average creditors were 20,000. What it means? The creditors turnover ratio is 6 times. So average payment period will be 12 months upon 6. That is 2 months. It means this year you are making payments to your creditors after every 2 months. I mean to say if you buy the goods today, you are able to make payments after 2 months. It's not a good sign for this company, because last year the company was able to make the payments after 1 month, but this time the company is able to make the payments only after 2 months. It means company is running short of short-term funds. It means there's something wrong with the current assets of the company. Suppose in a company, cash purchases are rupees 1 lakh, cost of goods sold is 3 lakhs, opening stock 1 lakh, closing stock 2 lakhs, and creditors turnover ratio is 3 times. Calculate opening creditors and closing creditors. Closing creditors are rupees 1 lakh excess of opening creditors. It means closing creditors are higher than opening creditors. So we have to calculate opening creditors and closing creditors. Now just think of a formula where opening creditors and closing creditors are involved. And the formula is creditors turnover ratio. Because in that formula, that is net credit purchases upon average creditors. And average creditors is equal to opening plus closing upon 2. And creditors turnover ratio is 3 times as per our question. And it means 3 is equal to net credit purchases upon average creditors. As per given information, I think we can calculate or we can reach credit purchases. Now think of a formula where purchases or credit purchases are involved. That is cost of goods sold. You know the formula of cost of goods sold is opening stock plus purchases minus closing stock plus direct expenses, or we can say material consumed plus direct expenses. You know cost of goods sold is equal to material consumed plus direct expenses, and material consumed is equal to opening stock plus purchases minus closing stock. Purchases means total purchases. So as per this equation, 3 lakhs, that is the cost of goods sold, is equal to 1 lakh plus total purchases. We have been given cash purchases, but we don't know about credit purchases. Let's assume the credit purchases are X. So 1 lakh plus 1 lakh plus X minus 2 lakhs means closing stock plus 0. We are going to assume that direct expenses are 0. So that will be equal to, means 3 lakh is equal to X. It means X is equal to 3 lakhs. And X means credit purchases are 3 lakh. So creditors turnover ratio is equal to credit purchases upon average creditors. And that will be equal to 3 is equal to 3 lakhs upon average creditors. Or we can say 3 into average creditors is equal to 3 lakh rupees. Or average creditors is equal to 3 lakh upon 3 means 1 lakh rupees. So our average creditors are rupees 1 lakh. You know average creditors is equal to opening creditors plus closing creditors upon 2. Suppose opening creditors are X, then the closing creditors will be X plus 1 lakh, because it's clearly stated in the question that closing creditors are excess of opening creditors by rupees 1 lakh. So the total will be 2X plus 1 lakh upon 2 is equal to 1 lakh. So the value of X will be 50,000 rupees. It means opening creditors are 50,000 and closing creditors will be 50,000 plus 1 lakh. That will be 1 lakh 50,000 rupees.